Every time you swipe a new credit card or finance a car, you are handed a standardized box detailing the exact annual percentage rate you will pay. We take this universal pricing metric completely for granted, assuming lenders have always been forced to tell us what our debt actually costs. Yet the standardized federal truth in lending law we rely on today was not introduced until 1968. Before that year, applying for a loan did not involve a universal, clearly stated annual percentage rate. Who decided you would finally see the real cost of a loan, and how did a massive industry operate in the dark for so long? This is fundamentally a story about information asymmetry and raw economic power. When lenders control the mathematics of debt, they control the borrower. For decades, the architecture of American credit was deliberately designed to be unreadable. In the years following the Second World War, the American economy entered an unprecedented period of consumer expansion. Returning soldiers and newly formed families rushed to buy homes and automobiles on installment plans. Consumer credit exploded, transforming from a stigmatized necessity into the primary engine of the middle-class dream. But this massive influx of retail debt occurred in a complete regulatory vacuum. Without a standardized federal requirement to disclose the true cost of borrowing, lenders engaged in a highly profitable free-for-all. If you walked into a bank in 1955, you would almost never hear the phrase annual percentage rate. Instead, loan officers quoted a bewildering array of numbers designed to sound incredibly cheap. They used add-on rates, discount rates, and flat monthly fees that masked the punishing reality of the underlying math. The most common tool of deception was the add-on rate method, which the loan officer's ledger would proudly display as a low single-digit figure. If you borrowed $1,000 at a 6% add-on rate for 1 year, the lender simply calculated 6% of the original principal. That added exactly $60 in interest, making the total repayment $1,060. You would then sign a contract to pay that total back in 12 equal monthly installments. On paper, 6% sounded like a fair deal, but the mathematics concealed a devastating catch. As you made your monthly payments, the amount of money you actually owed the bank steadily decreased. By the 6th month, you only held half of the borrowed money, yet you were still paying interest calculated on the full original $1,000. The true annualized cost of that money was nearly double the quoted rate. Other institutions utilize an even more aggressive accounting trick, known in the loan ledger as the discount method. Under this system, the bank calculated the interest on the full amount up front and immediately subtracted it from the cash they handed you. If you signed a contract for a $1,000 loan at a 6% discount rate, the bank only handed you $940. You were paying interest on money you never even received, pushing the actual borrowing cost even higher. Beyond the misleading interest calculations, the final promissory notes were padded with a labyrinth of hidden surcharges. Lenders quietly folded mandatory credit life insurance, processing charges, and exorbitant late penalties into the monthly payment. Because there was no standardized federal requirement to lump these costs into one transparent figure, borrowers had no mathematically sound way to compare competing offers. Shopping around for credit was practically impossible when every bank spoke a different mathematical language. The human toll of this opaque system fell heaviest on working-class families structurally excluded from prime banking networks. Forced into the arms of unregulated installment merchants, these borrowers often found themselves trapped in perpetual debt cycles. A seemingly affordable television set could end up costing 3 times its retail price once the compounded fees fully materialized. Default rates spiked, and the aggressive collection tactics that followed frequently destroyed livelihoods. The sheer scale of this economic drain eventually caught the attention of an unconventional figure in Washington. Paul Douglas was an economics professor turned United States Senator from Illinois, and he despised the deliberate obfuscation of financial contracts. In 1960, he decided to drag the secretive math of the lending industry into the public spotlight. He drafted a seemingly simple bill requiring all lenders to state the cost of credit in two standardized ways. The drafted legislation demanded that the total finance charge be clearly written in dollars and cents on every loan document. More importantly, it required lenders to express that charge as a true annual percentage rate on the declining balance of the loan. This was the exact mathematical standard the industry had spent decades trying to avoid. Senator Douglas believed that if working Americans could simply see the true price of their debt, the free market would naturally drive down predatory rates. The response from the financial sector was immediate, organized, and fiercely hostile. Retailers, bankers, and auto dealers formed a unified front, warning Congress that the proposed legislation would destroy the American economy. They argued that forcing lenders to reveal true annual percentage rates of 12, 18, or 24% would terrify consumers. The industry openly admitted that their business model relied on keeping the public blissfully unaware of the actual mathematics. For the next several years, the bill languished in committee, effectively blocked by powerful banking lobbyists and sympathetic politicians. Every time Senator Douglas attempted to advance the legislation, it was systematically buried under technical objections. But the mounting pressure of consumer debt was quietly creating a political powder keg that was about to ignite. By the mid-1960s, the sheer volume of hidden interest charges was pushing millions of American families toward financial ruin. Personal bankruptcies surged to record highs, driven heavily by predatory installment contracts and the explosive growth of early credit cards. The political establishment could no longer ignore the devastating human cost of this opaque financial machinery. Senator Douglas continued to hold fiery committee hearings, bringing in working-class borrowers who had been financially destroyed by hidden fees. The official congressional transcript recorded agonizing stories of families losing their homes over minor purchases that ballooned through compounded interest. Yet the banking lobby held its ground, pouring money into campaigns to defeat any politician who supported the legislation. In a devastating blow to the movement, Paul Douglas lost his re-election bid in 1966. The financial industry celebrated, assuming the push for a standardized federal truth in lending law was finally dead. But the crusade was immediately inherited by Senator William Proxmire of Wisconsin, a relentless legislator who understood how to outmaneuver the banking lobby. Proxmire realized that defeating the financial sector required framing the issue not just as a math problem, but as a fundamental consumer right. He formed a strategic alliance with Representative Leonore Sullivan, a fiercely independent congresswoman from Missouri who refused to accept any compromise version of the bill. Together, they began rewriting the legislation to close the specific loopholes the banking industry relied upon most heavily. The most bitter battleground became the emerging, highly lucrative world of revolving credit. Department stores and early credit card issuers fought viciously to keep their monthly finance charges exempt from annual percentage rate calculations. They argued that revolving balances fluctuated daily, making a single annual rate mathematically impossible to calculate in advance. Representative Sullivan demanded that the House committee draft explicitly require revolving credit accounts to display an annualized rate. The drafted committee report forced retailers to multiply their standard 1.5% monthly charge by 12, exposing a true annual rate of 18%. For the first time, the massive department store lobby faced the very real threat of having their most profitable system exposed. The political tide finally turned when the executive branch threw its full weight behind the consumer protection movement. In early 1968, President Lyndon B. Johnson declared that the American consumer had the right to know the true cost of their debt. His official message to Congress demanded the immediate passage of a comprehensive, loophole-free truth in lending statute. With the president forcing the issue, the resistance of the financial lobby began to fracture. Proxmire and Sullivan leveraged this momentum to force a decisive vote in the Congressional Conference Committee. The resulting conference report merged the strongest provisions from both the House and the Senate into one unified legislative weapon. This definitive document meticulously defined exactly how the new universal metric would be calculated across the entire United States. The finalized statutory text mandated that every single mandatory fee, from credit life insurance to administrative processing charges, be added directly to the finance charge. Lenders were stripped of their ability to hide their profit margins in the fine print of separate add-on documents. The legislation required the newly defined annual percentage rate to be printed in bold, conspicuous type on every single consumer credit contract. The standard loan disclosure form was completely redesigned to feature this percentage prominently inside a highly visible boxed section. Any lender who attempted to obscure this number or revert to the old discount methods faced severe federal penalties. The regulatory authority to enforce these sweeping new rules was handed directly to the Federal Reserve Board. The board was tasked with writing Regulation Z, the massive rulebook that translated the new law into precise mathematical formulas for every bank in the country. The official Federal Reserve drafting ledger detailed the exact algebraic equations lenders were now legally required to use. Banks were given exactly 1 year to overhaul their entire accounting infrastructure before the law took full effect in 1969. Loan officers had to be completely retrained to explain the very annual percentage rates they had spent their careers avoiding. The compliance manuals distributed to bank branches across the nation warned that non-compliance would result in immediate federal prosecution. On May 29, 1968, the Truth in Lending Act was finally signed into law as Title I of the Consumer Credit Protection Act. After 8 years of bitter legislative trench warfare, the era of deliberately unreadable consumer debt had officially ended. The American public was about to see the true price of their borrowed money, and the financial industry would never be the same. On July 1, 1969, the sweeping provisions of the new federal law officially went into active effect across the United States. Overnight, millions of American consumers opened their monthly department store billing statements and experienced a profound financial shock. The familiar 1.5% monthly fee was suddenly accompanied by a bold, unavoidable printed declaration of an 18% annual percentage rate. This was the precise moment the architecture of consumer credit fundamentally shifted from hidden manipulation to mandated transparency. The standardized loan disclosure form, now legally required at every bank desk, forced loan officers to point directly to the true mathematical cost. Borrowers who thought they were paying a simple 6% add-on rate stared at contracts explicitly warning them the real cost was 11%. For the first time in modern history, a working-class family could take a financing sheet from a local auto dealer and directly compare it to a credit union offer. The mathematical standardization stripped away the deliberate confusion of discount rates and hidden ledger fees. Lenders could no longer rely on the sheer complexity of their paperwork to extract unearned profit from confused retail buyers. Federal regulators did not simply trust the banking industry to comply with these revolutionary transparency requirements out of goodwill. The newly empowered Federal Trade Commission deployed field examiners to audit the internal accounting records of retail merchants and local loan companies. An examiner's field report could instantly trigger massive financial penalties if a business was caught attempting to bury the annual percentage rate. Despite this strict enforcement, the passage of this landmark legislation did not magically eradicate predatory lending from the American economy. The financial industry simply adapted to the new rules, shifting their profit strategies from hidden interest rates to behavioral exploitation. The modern credit card agreement evolved into a dense, multi-page legal labyrinth designed to overwhelm the borrower with sheer volume. While the annual percentage rate remained boldly boxed at the top of the application, banks engineered new ways to make that number seem irrelevant. They introduced variable rate structures, where the fine print of the promissory note allowed the interest to quietly adjust based on federal benchmarks. The battleground moved away from hiding the core math and toward masking the trigger conditions for punitive penalty rates. By the late 1980s, the sheer volume of credit card offers flooding American mailboxes necessitated even stricter visual standardization. Congress eventually mandated the creation of a highly rigid, standardized pricing table that had to appear on every single promotional mailer. This standardized disclosure chart finally forced all competing banks to display their fees, grace periods, and rates in the exact same visual format. Today, financial institutions weaponize complex reward points and sign-up bonuses to distract consumers from the mandatory disclosures they fought so hard to prevent. The compliance ledger might show a perfectly calculated annual percentage rate, but the borrower is entirely focused on earning enough miles for a free flight. The information asymmetry that Paul Douglas fought against simply mutated into a more sophisticated psychological game. The federal truth in lending law remains one of the most critical pieces of consumer protection architecture ever built, fundamentally altering how we interact with debt. Yet, as credit products grow increasingly gamified, one must ask if mere transparency is enough to protect borrowers from sophisticated financial engineering. Does mandating a clear annual percentage rate actually empower consumers? Or does it simply give lenders legal cover to charge exorbitant fees in plain sight? If you want to continue uncovering the hidden history of the everyday financial systems that silently govern our lives, subscribe to the channel.